to GK's educational spiritual videos. We are explaining the 2 marks concepts in junior intermediate from 6th chapter to 10th chapter. The 6th chapter name is distribution. In that chapters we are expecting 8 2 marks questions. One is contract rent. Rent or price which is actually paid for the services of land, building, vehicles according to an agreement made earlier for given period of time is called contract rent. Example, house rent, a vehicle rent. Second, transfer of earnings. The concept of transfer of earnings introduced by the Joan Robinson. It is also called opportunity cost of a factor. It refers to the surplus earned by a factor in its next best alternative. Economic rent is equal to transfer earnings minus current earnings. That is a formula. Scarcity rent. Scarcity rent is a surplus earned by the land which has inelastic supply. Professor Marshall explained the concept of scarcity rent on the basis of demand and supply. Quasi rent. Quasi rent is the surplus earned by the man-made appliances, instruments and machines of production whose supply is inelastic in the short period in relation to their demand. Alfred Marshall introduced quasi rent concept. Real wages. Real wages refers to the purchasing power of money wages received by the labor in terms of goods and services. Real wages is equal to money wage by price level. Gross profit. Gross profit is the difference between total revenue of a firm and total cost of production. Gross profit is equal to total revenue minus total cost, or gross profit is equal to net profit plus implicit rent, implicit wage, implicit interest, depreciation and insurance charges. Net interest. This is the payment made to lender of capital for the services of capital only in the process of production. Net interest paid on the government bonds, securities and loans. Net profit. It is the reward paid for the organizer entrepreneur skills. It is reward for performing the duties like risk taking, innovation, marketing and coordination. Next, national income, 7th chapter. Per capita income. Per capita income is the average income of individual of a country. It is calculated by dividing national income of a country by population of the country. So per capita income is equal to national income by population. Depreciation. The country's stock of fixed assets undergoes certain amount of wear and tear in the producing goods and services over a period of time. This is depreciation. It is also called user cost or charges of renewals and repairs. Disposable income. Disposable income is that part of personal income which is available with individual after payment of all direct taxes like income tax and property tax. Disposable income is equal to personal income minus personal taxes or consumption plus saving. Gross national product. It is the current market value of all final goods and services produced in a country during a given period of time. GNP is equal to C plus I plus G plus X minus M plus net factor income from abroad. And eighth lesson, macroeconomic aspects. 1. Full employment. Full employment is a situation in which all those who are willing to work at the existing wage rate are engaged in work. Laissez-faire. One of the assumptions of classical economists is laissez-faire. It refers to the non-interference of the government in economic activities. It is nothing but free trade economy. 3. Budget. Budget is the annual statement of the estimated receipts like income and the estimated expenditure of the government for a financial year April 1st to March 31st. It is also called annual financial statement. Classical economist. The term classical economist refers to the body of economic theories formulated latter half of the 18th century to the early part of 20th century. The most important principles of classical economists: personal liberty, private property, and freedom of private enterprise. The leading economists like Adam Smith, Malthus, David Ricardo, J.S. Mill, Alfred Marshall, and A.C. Pigou. Deficit budget. The budget refers to the in which total expenditure exceeds the total revenue. Deficit budget is equal to total expenditure minus total revenue. Fiscal deficit. Fiscal deficit is the difference between the total expenditure and total revenue plus market borrowings and other liabilities. Effective demand. Effective demand is a point where the aggregate demand equals to aggregate supply. When aggregate demand is equal to aggregate supply, country or economy is in equilibrium. JBC law of markets. According to the JBC law of markets, supply creates its own demand. Supply always equal to its equal demand. It can be expressed as S is equal to D. JBC market law explains the goods market equilibrium. And each chapter, money and banking. Liquidity. Liquidity is the ability of asset to be converted into money act as a direct medium of exchange. Money has more liquidity when compared to other all assets. Currency. Currency is the form in which money is circulated in the economy by the monetary authority like government and the central bank. Currency includes coins and paper notes. Overdraft. It is a facility allowed by the bank to the current account holders. They are allowed to withdraw money with or without security above their balances. Near money. The term near money refers to those highly liquid assets which are not accepted as money, but it can be easily converted into money within a short period of time. Example, saving deposits and treasury bills. Inflation. The term inflation refers to the persistent appreciable rise in the general price level over a period of time. Inflation means a rise in the general price levels. Hyperinflation. The inflation rate exceeds 10% per annum. Hyperinflation occurs. It is also called galloping inflation. Store value. The value of commodities and services can be stored in the form of money. Some commodities are perishable if they are exchanged for money before they perish. Creation of money or credit money. Commercial bank create credit. Credit is created by out of the primary deposits received from the public. They are also called bank money. Reserve Bank of India. Reserve Bank of India is the highest banking system in our country. It controls, regulates, supervises activities of the banks. In our country, the central bank was established in 1935. Under private management, it was nationalized by the government in 1949 and named as RBI. 10th chapter, Economic Statistics. Arithmetic mean. Arithmetic mean is a statistical data defined as a quotient of the sum of the items divided by the number of items. Sigma x by n. Pie diagram. Pie diagram is also component diagram. It is also called as chart. The circle is divided into many parts as there are components by drawing straight lines from the center to circumference. Bar diagram. Bar diagram comprising a group of equispaced equiwidth rectangular bars for each class of category of data. Median. Median is the middle element when the data is arranged in order of magnitude. Median is that positional value of the variable which divides the distribution into two equal parts. It is denoted by M. Recorded, sir.